But let's talk about what we saw play out in the markets post FOMC decision. We've seen the bond yield hit a 15-year high, at least if you're talking about the 10-year, that's shorter, and the 2-year hitting a 16-year high. In many ways, we heard from our guest yesterday saying, look, the bond market is actually doing the work for the Fed by tightening credit. How do you see this move in relation to the potential for another rate hike in November?
Yeah, well, first of all, the move, the quickness in the move is what kind of scared the market. We broke out above 4.3% in the 10, and we're staying above 5% in the 2s. We're getting a little bit of a pullback today, but it was that, higher for longer that scares us. We focused on the dot plot. The dot plot, when you looked at the last one, we talked about next June being at 4.6%. Now, next June, they're saying 5.1%. So they're saying we're not cutting at all for the next 9 months. That kind of caught everybody by surprise. And then his tone was a little more hawkish than we anticipated. Temper it down a little bit. I know he said the same thing. It was just like pull the string, hear him say, we're data dependent. We'll look at each economic data point as they come. So we'll watch the PCE next Friday and go from there. But he was a little more hawkish than we anticipated. And these yields, while down a little bit today, these historic levels have reason for us to be concerned.
Jay, what's the expectation if you look specifically at the 10-year? Do you see more room to run? We're looking at 4.43 today, 4.5%, inching towards 5%. Where do you see it going?
Well, as a technician, I want to say that this is a bull trap, and this breakout is going to fail, and we'll get back to 4.3 and hold there. But right now, it doesn't seem that way. It seems like the 10 years got a run towards 5%, and that will really throw off basically the high growth names, the technology names, the names that have really been beaten down over the last few weeks that are getting to key levels. So I look at the Qs, then I look at the semiconductors, and there's reason to be concerned. Yeah, you think they're going to hold certain levels, and corrections are normal, and right now this is a normal correction. But if these yields continue to climb the way they've been, it could make the fourth quarter a little more challenging than we hoped.
And of course, that benchmark 10-year, Jay, that's helped set everything from student loans, credit cards, mortgages, those higher borrowing costs. What's that going to mean for the American consumer? What's your outlook for the consumer?
Yeah, the outlook, the headwinds, first of all, let's separate the economy from the stock market, because the economic conditions, they don't look good. And yes, the headwinds and the student loan repayments, these are things we're worried about. But the market has done remarkably well. At the beginning of the year, it was all about the recession that has yet to happen. And now we're concerned about rates. If the rates slow down, and that's why I said the speed of which they move is important, I think the market can catch up once we get to this next earnings cycle. We're at a point where we're not getting any real earnings. The earnings that we've gotten have been actually good. Look at NVIDIA as a perfect example with good earnings, or a Broadcom, and they've sold off. So I think we need to get through this next cycle of earnings. But yeah, I mean, the headline risk, it's tremendous. And we have a government shutdown looming. That's another thing that we're going to be talking about all next week.